Webster's here. Liz McDonald turns up on a Friday occasionally. Scott Shellady is here, and Jeff Sica too. Sorry, Liz. I do apologize.
Okay.
I want to go round the block here. The GDP is, the economy is growing at a meager 1.1% annual rate. Jeff Sica, you're a perma-bear on stocks. Does this fit your narrative?
Well, you know, this should be an indication of why I'm a bear.
Right.
I mean, first of all, this is the worst recovery we have seen in decades. You're talking about the average recovery. We see GDP around 2–3%. This is going towards a sub 1% GDP. There's two things to keep in mind. The first is that businesses are not spending. Capital expenditures are tanking every single quarter. And the second is this is an indication of where we're going with corporate earnings. We have to be very aware of the fact that when you have a historically high market, it needs to be accompanied by rising earnings and improving economic conditions for the economy overall, and we don't have that.
And to Jeff's point, corporate profits in the second quarter, net corporate profits down 2.4%. So that investment, that business spending is just going to fall even more looking forward.
Yeah, that's like about a year and a half's worth of negative growth in S&P 500 profits. Where are the animal spirits? Companies are acting more like church mice, running away from whatever the government's going to tax and regulate them. We've got $2 trillion parked overseas. That's the cheapest stimulus of all.
Who just chimed in with the word right? Was that you, Scott Shellady? Was it?
Yeah, it is. You know why? Because I hate to say it, Stuart, but I'm a common sensocrat, right? Things just don't add up. You can't be at full employment, 4.8% unemployment, and have a GDP of 1.1%. It doesn't square. Why aren't people screaming about the fact that with all these people going back to work, we only have a 1.1% GDP? What are they making? Home ownership at 51-year lows? I mean, something doesn't add up here, and nobody's ringing the bell.
Okay, hold on a sec. Scott, this one's for you too. It's a headline in the Wall Street Journal. It says, years of Fed missteps fueled disillusion with the economy in Washington. Once revered central bank failed to foresee the crisis, struggles in the aftermath, fostering the rise of populism and distrust of institutions. We'll leave it on the screen for a while so you can read it for a while. But Scott, that's a pretty damning conclusion on the Federal Reserve, is it not?
It is, because we've jumped into this pool, Stuart, and I've said it before, we've jumped into this pool where the Fed stays data dependent, but the data is dependent upon the Fed. Exactly. I mean, that's a negative loop if I've ever seen one. So that's, until we get rid of that, nothing's going to change, and they're going to continually miss their mark. I mean, look, by the end of 2018, they're expecting us between 2 and 2.5% in interest rates. How are we going to get there at this pace? I mean, really, could somebody just call them out on that, please?
And
say we have something wrong here, ring the bell.
3% growth,
Wait a second,
annualized or whatever, annualized.
You are
in the
referring to what Ms. Mester, Loretta Mester, president of the Cleveland Fed, said this morning. Oh, don't worry, we're going to get 3% growth by the end of the year.
Guess what? We call them out on that and here in Varney and Company. How?
It just
push
proves
back.
that they
You tell
don't
us
know
how you're going to get there.
They don't know what they're talking about.
By the way, everyone, at 10 o'clock sharp Eastern Time, we'll bring you exactly what Fed Chair Yellen has to say about interest rates. Right there at 10 o'clock, you will have it almost first. Right, overall market. I hear Scott Shellady sighing in the background. He can't handle this. Look at the Dow 30. 28 of them are up. And by the way, Citigroup says a Trump victory in November could cause a global recession. All right, Jeff, chime in.
Okay, well, let's first make it clear that the banks, Hillary Clinton is clearly in the hands of the banks and vice versa. So the fact that this comes out now, let's make one thing perfectly clear. We are in a sub 2% now. Citigroup is saying we'll go to 2%. That's actually an improvement from where we are now. So the fact that they're coming out and saying this now is beyond ironic. It's beyond appalling, because the bottom line is a Hillary Clinton presidency will do nothing but harm the economy.
Yeah,
that's the bottom line.
Fascinating. All right, some individual stocks.